Welcome to the MarketBiasTracker Weekly Stocks Roundup. This is your structured look at where leadership sits, where pressure is building, and what the board is telling us heading into next week. The broad tone this week is split. Out of 50 names tracked, 16 are reading bullish and 16 are reading bearish. That is an even divide, and the average score across the board sits just above 5. The headline looks balanced, but balanced does not mean healthy. When you have equal weight on both sides, it often means the market is not moving as one. Leaders are holding up, but weakness underneath is real. On the bullish side, Broadcom is the strongest name on the board this week. Its bias is confirmed across both the hourly and daily time frames, with trend structure intact and momentum still leaning positive. Apple is also reading bullish, supported by a clean daily trend stack. Cisco rounds out the top three, also carrying a bullish read on both time frames. All three are tech-adjacent names, and that concentration matters. The leadership this week is not coming from across the market, it is coming from one corner of it. On the weak side, Netflix is the lowest scoring name tracked this week. Both the hourly and daily reads are bearish, with trend structure pointing down across time frames. Johnson & Johnson is also in bearish territory, with the hourly showing strong bear pressure even as the daily sights closer to neutral. Walmart is the third name on the weak side, carrying bearish reads on both time frames and showing some of the more elevated exhaustion readings on the board. Consumer and healthcare names are carrying the pressure this week, while tech holds the lead. That contrast tells the leadership story clearly. The bullish names are clustered in technology. The bearish names are spread across consumer and healthcare. This is not broad market strength, it is sector rotation at best and fragile leadership at worst. When the names holding up are all from the same area of the market, the overall picture deserves more caution than the headline score suggests. The main caution this week comes from exhaustion and stretch readings on several of the leading names. Apple is carrying elevated exhaustion flags on the daily time frame. Cisco is showing a bearish divergence signal on the daily, where price made a higher high, but momentum did not confirm. Broadcom swept above a key resistance level and was rejected, which is a pattern worth watching. These are not signals to act on. They are structural notes that say the leaders may be working harder than they look. Strength that is stretched is not the same as strength that is fresh. Heading into next week, the key watch is whether leadership broadens beyond the current tech cluster. If names outside of technology begin to confirm bullish structure, that would be a more constructive read for the overall board. If the weak side deepens, particularly in Netflix and Walmart, that would suggest the split is widening rather than resolving. The trend friction flag on the hourly remains the top caution tag across the board, and it is worth watching whether that clears or spreads to more names. That is your weekly stock context from MarketBiasTracker. Everything here is structural and educational. Visit MarketBiasTracker.com for the full board. This is market context, not a signal.